All right, well, hello everyone. This is Dr. Sam Lanzafame again, and today we're going to be talking about dividends. In particular, we're going to focus on cash dividends, and then I'll have another video just on stock dividends where we'll get into some detail relating to those types of dividends. But for today, our main focus is going to be cash dividends. So I have a template up here that I've kind of pre-worked here ahead of time, and I'd like you to focus on the green area at the top left, where you notice there's the topic dividends, and I have underneath column C three important dates. That's the date of declaration, the date of record, and the date of payment or date of distribution. The term payment is used when we're talking about a cash dividend. We usually use the word distribution when we're referring to a stock dividend. As you notice in number 2 where it says date of record, in parentheses I have no JE. JE is short for journal entry. So there is no journal entry associated with the date of record. It's more of an FYI. Okay? Basically determines ownership of the outstanding shares. So whoever has stock at the time of date of record, then those are the people that are entitled to the stock dividends or cash dividends. So in other words, I could have had stock for 30 years and sold it yesterday, and the corporation declares a dividend and the date of record is tomorrow. I lose out. So it has nothing to do with how long I have the stock. It all depends on if I am the owner of the stock on the date of record. If so, I get a dividend. If I'm not an owner as of the date of record, I'm out of luck. So the journal entries that would be required would be for step 1 and step 3, or date 1 and date 3. So let's go ahead and do the journal entry for the date of declaration. To the right in columns D, E, F, and G and H there, I have some data. So let's pretend the company has 100,000 shares of $5 par common stock. That's what they have in their existence, in their equity, in their portfolio. And the company declares a $2 per share dividend. Okay? So the way that would work is on the date of declaration, the company would then debit cash dividends. You may actually have an account called cash dividends declared. I'll actually use that just so it's even clearer. So we would debit this account called cash dividends declared, and the math involved here would be, since there's 100,000 shares in the possession of the stockholders, so I probably should have written 100,000 shares outstanding. So whatever is in the hands of the stockholders, those are the people that are eligible for the dividend. So I'm going to go 100,000 shares, and I'm going to multiply that by the $2, and that's going to give me $200,000. And then what I want to do is credit dividends payable for the same amount. Remember, your debits have to always equal your credits, so that never ever changes in accounting. So debits have to always equal our credits. So debit cash dividend declared, credit dividends payable. So on the date of declaration, the corporation is saying, hello everybody, we're going to be giving out dividends, and we'll let you know when we'll pay them out. So basically, a liability is created by the corporation called dividends payable. They now owe their stockholders 200 grand. As I said earlier, there is no uh, journal entry on the date of record, so this is a non-event from a journal entry point of view. Okay, it's just an FYI. On the date of payment, date of distribution, this is when the corporation actually finally pays up what they said they were going to pay. And the journal entry basically would be, let's eliminate the liability that we created in the first entry. So we're going to debit dividends payable, and we're going to debit that for the $200,000 that we originally created. And since we're paying them, we're actually giving them cash. So literally, by being an owner at this company, and you are the owner of that stock as of the date of record, if the company decides they want to give a cash dividend, sweet. Then we're going to get basically free money if you're the stockholder. Corporation, however, they're the ones who are dishing out the money. And remember, we're always looking at it from the company's point of view. So the company's cash has now gone down, and 200,000 is going into the hands of the stockholders. So those are the three important dates, and we just did an example, that involved all three. So let's now focus our attention here, where I have types of dividends and basically the stuff that I have in yellow. There are two types of dividends. We've got cash dividends and we have stock dividends. Again, as I said earlier, our focus today is just on the cash dividends, but just a quick little FYI, there are two types of stock dividends, small and large. And a small stock dividend is typically less than 25%. Some corporations look at it less than 20 to 25. They have like a little range there, but just easier if we just kind of remember one number. So less than 25%. A large stock dividend would be 25% or greater. So sometimes when a corporation doesn't have the cash flow to be able to give their stockholders a cash dividend, they'll give them a stock dividend, meaning they'll give them more stock. It's kind of like, when a baby's crying, you give them a pacifier. And I always kind of look at stock dividends as more of a pacifier. However, the potential of this pacifier is great because if the stock price rises, man, that's going to be easy money and free money for the stockholders. But in the meantime, it's the company kind of showing good faith and saying, hey, we appreciate you being a stockholder and we just want to give you a little bit of like a little bonus, so to speak. Since we don't have the cash to give you cash, we'd rather, or maybe we want to use the cash for investing or R&D or who knows what they need it for, or maybe they're just low on cash flow. So they might decide just to give a stock dividend to kind of pacify the stockholders. They don't want to lose these investors. So just a quick little comment on this. Cash dividends, as we saw in the green earlier, by the way, has an impact on the accounting equation, which I have listed over here. So the accounting equation, as you know, since the very first chapter, we know that it's assets equals liabilities plus equity. Here in, the corporation chapters, the equity has been customized to be stockholders' equity. If this was a partnership, it would be called a partnership equity. If this was a sole proprietorship, it would be called owner's equity. But bottom line, it's equity, no matter how you slice it. So assets equals liabilities plus stockholders' equity. If you look at the journal entry we just did, I have a debit to cash dividends declared, a credit to dividends payable. The part that I didn't show is eventually cash dividends declared has to be closed. So I'm just going to do an extra entry down here, and I'm going to put that in green so you can see that this is connected to what we were dealing with. Let me put a box around it. So let's talk about closing entry number 4. Closing entry number 4 is when the corporation has to close their dividends into retained earnings. So as you can see from number 1 at the top, we debited cash dividends declared. Well, that account is going to have to be closed. How do you close an entry or an account that is currently containing a debit balance? Well, remember, you got to do the opposite. So to close something with a debit balance, you are going to basically credit it. Okay, so that's what we're going to do. Let me just fix this here. I got a little crazy. There we go. Okay, so closing entry number 4 looks something like this. You're going to debit retained earnings. You may remember this from a previous video that I did, and you're going to credit the cash dividends declared. Okay, and that would be for the 200,000 that we were discussing earlier. So it's this 200,000 that we're closing out. Okay, so when you analyze this situation, you will notice that dividends declared was dumped into the retained earnings account. Do you know that some companies will basically bypass closing entry number 4 so that they only have 3 closing entries? And the way they can get away with that is in this first entry that you see here, instead of debiting cash dividends declared, they'll just debit retained earnings directly. In other words, they'll just bypass this little middleman account called cash dividends declared. So in other words, in this first entry, if the company debits cash dividend declared, they will then have to do this journal entry, which is the closing entry number 4. If the company doesn't want to do closing entry number 4, then in this first entry, they would have to debit retained earnings. Okay, so I just want to make sure you're aware of that. So you could take the shortcut and just debit retained earnings right off the bat and credit dividends payable. If you do that, then you won't need to do closing entry number 4. Okay, so but since I've done it, whether I took the shortcut or didn't take the shortcut, the bottom line is the dividends payables basically have canceled each other out, and now the cash dividends declared have basically canceled themselves out. What do I have left? Cash and retained earnings. Okay, so basically, if I look at my impact on the accounting equation, because cash is going down, that means my assets are going down. And because I have retained earnings as a debit, that means my stockholders' equity is going to go down as well. So because retained earnings is decreasing, your stockholders' equity is going down. I'll just put SE this way. So basically, whenever there is a cash dividend, both sides of the accounting equation are impacted. And in fact, both sides decrease. So you see stockholders' equity going down, and you also see the assets going down. Let me actually write decrease. Okay, so I just wanted to let you know of the impact of a cash dividend. Let's put this in green just to make all of our cash dividend stuff in green. Okay, so now, even though today's topic isn't about stock dividends, let me just explain to you the impact of a stock dividend on the stockholders' equity section. Believe it or not, only the stockholders' equity area is impacted. In other words, assets are not impacted, liabilities are not impacted, only stockholders' equity when there is a stock dividend. So let me just kind of do this, make this all nice and yellow. And just to let you know, when there's a stock dividend, basically what's going to happen is you're going to give your stockholders more stock. So your common stock goes up. It's possible that you could have a PIK account involved. So your PIK account may also go up if it was involved. There may not be any PIK, however, so that's a possibility. And your retained earnings go down. So no matter what kind of a dividend you have, whether it's a cash dividend or a stock dividend, retained earnings will go down. When it's a cash dividend, your cash goes down because you're giving your stockholders cash. But when it's a stock dividend, you're giving your stockholders more stock. So the common stock and maybe the PIK account will go up because of that. Okay? So when you have a cash dividend, both sides of the accounting equation or balance sheet are impacted. But when you have a stock dividend, only the stockholders' equity section is impacted. And basically, the total of stockholders' equity remains the same, but the retained earnings washes out with the stock and PIK account. So they basically offset each other, but the total remains the same. The total of the stockholders' equity actually goes down when you have a cash dividend. The total of the stockholders' equity remains the same if you have a stock dividend. It's just the components inside the stockholders' equity are switching amounts that offset each other. Finally, we have stock splits, and a stock split does not affect any part of the accounting equation from a dollar perspective. So with a stock split, we have no impact dollar-wise on the balance sheet or accounting equation. What happens in a stock split is that the values that make up the dollar value, those are what changes. So for example, if I had, let's say, 1,000 shares of $2 par common stock, and the corporation declares a 2-for-1 stock split. Now, me as a stockholder, I would love it if my stock split. Having your stock split has no instant gratification, but it's the potential of what could happen with that stock if it ends up growing at a great rate. You basically will end up with a lot of money if your stock splits and then it continues to grow after the split. But let me just explain to you how the stock splits here. So to show you that there's no instant gratification here, first off, let me just do the original math. If I take the number 1,000, which is the 1,000 shares, and I multiply it by the $2, that's going to give me $2,000 as the value of my stock, in essence. If the stock splits 2-for-1, that means for every 1 share I had, I now have 2. So now, after a stock split, I'll have 2,000 shares, but the stock value will be cut in half. So if I take 2,000 and I multiply it by 1, I get 2,000. So you notice that there is no change in the dollar value of the stock, even though we had a stock split. So before the stock split, I had $2,000 worth of stock. After the stock split, I had $2,000 worth of stock. But I now have more shares, but they're worth half as much as they were before. So there's no instant gratification for me as a stockholder. However, if the stock decides to grow, in other words, people find interest in it and the market value of the stock grows. Let's say, before the stock split, uh, on the stock market, the stock was selling for $10 a share. Now, let's say the stock sells for $20 a share. Sweet. I now have 2,000 shares that I can sell at 20 bucks a pop, as opposed to, before when it was only worth $10 a pop. So there's a definite opportunity for growth when your stock splits. The reason why companies split their stock is because it's probably getting out of hand, and meaning it's getting too pricey, and a lot of stockholders are probably staying away from it because it's becoming too expensive. Okay? So I just wanted to throw that out there, that there's 3 types of ways that people that own stock can basically improve their situation. One way is through a stock dividend, one way is through a cash dividend, and the other way is through a stock split. Of course, the stockholders have no control over these things. The board of directors of the corporations are the ones who decide whether or not these dividends or splits are going to happen. Okay, so I just wanted to point that out to you. And now let's actually focus more on the cash dividends. And I'm just going to scroll down a little bit here. There are two types of stocks that a corporation has. One is called common stock, and the other one is called preferred stock. Typically, only about 25% of publicly traded companies even have preferred stock. So the majority of corporations don't have preferred stock. But if you're lucky to be a preferred stockholder, you get first crack at dividends, meaning that when the corporation decides to give out a dividend, the preferred stockholders are the ones who get the first piece of the pie. And whatever money is left over, a little bit or a lot, the remaining money goes to the common stockholders. There are different versions of preferred stock. We'll only talk about two of them here today. One version of preferred stock is called non-cumulative. I could get into participating and non-participating, but I'm not going to get into all that detail. We're just going to look at two types today. So we've got non-cumulative, and we're going to compare that to the preferred stock that is cumulative. If you had your choice of what stock you would prefer, you would pick the cumulative one. You will end up with more money in your pocket if you have cumulative preferred stock versus non-cumulative preferred stock. Okay? So let's say you're a corporation and you decide to give out dividends this year, and you've got preferred stockholders and you've got common stockholders. The preferred stockholders are the first ones who get the money. Anything that's left goes to the common. So I've created a little example here to the right, and I created a little chart for us to work with. Okay? And the preferred stock is non-cumulative, as you can see here. There's 80,000 shares, 7.5%, $5 par. So that is the detail associated with the preferred stock. In order to calculate how much preferred stockholders are entitled to, I literally have to multiply these three numbers. So I'm going to go 80,000 and I'm going to multiply that by the 7.5%. I'll multiply it by 5 first. Doesn't really matter. And then I'm going to multiply it by the 7.5%. Okay? And when I do this math, this is going to give me what the preferred stockholders are entitled to. So if I take 80,000, multiply it by 5, multiply it by 7.5%, I come up with $30,000. Okay? So that $30,000 is what the preferred stockholders are entitled to. So let's call this the dividend payment entitled there we go, to preferred. So it's kind of like a contractual agreement. So that little percentage that you see there is basically the dividend percentage. Okay? So preferred stockholders are entitled to $30,000 every year. The question is, will they get it? So let's take a look at the example that we have here, right? And with the scenario that we've just presented, let's figure out how much, common and preferred will end up getting. So in 2015, the corporation is giving out $20,000 in dividends. So that's the magic number right now, 20,000. So we want to figure out how much of this 20,000 is going to go to preferred and how much of it is going to go to common. Remember, preferred is entitled to the first $30,000 that the corporation decides to give out. So as you can see here, the corporation's only got 20,000 to give. Excuse me. So preferred saying, hey, I'm supposed to be getting 30. What's up with this? So, well, what the corporation's going to do is they're going to give preferred the entire 20. And unfortunately, common is going to get shut out. That's just the way it is. The money that the other $10,000 that preferred was supposed to get, sorry, we don't have the money. We're giving you 20. Be happy with that, is what the corporation's basically saying. You know, if we had it, we would have given it to you, but we don't. So basically, the other $10,000 is lost. That's the problem with non-cumulative preferred stock. If we don't meet the minimum, you just don't get it. Okay? So let's take a look at 2016. Looks like the same scenario is happening. The corporation has more money to give out in dividends, but it's still not the 30,000 that preferred was supposed to get. Oh well, sorry, nothing that can happen. But look at common, still nothing. So what's preferred complaining about, right? They're at least getting something. Common is getting shut out. So then we get to 2017. Remember, the first $30,000 goes to preferred. So guess what? They get their 30. They're finally happy. They finally get what they're supposed to get. And the remaining is going to be split between the common stockholders. So this time around, common really did well. Okay, so they're going to get 170,000. 200 minus the 30. And there's 170,000 that's going to common. And then in 2018, again, preferred will get their 30,000 and common will get the leftover. And that's big leftover. So 350 minus the 30, and look how much common is getting in 2018. Okay, so the moral of the story is that in year 2015 and 2016, preferred didn't get all of the money they were entitled to. They were supposed to get 30 every year, but the company didn't have the 30 in the first couple of years, and oh well, sorry, preferred stockholders. You only get 20 and 28. Okay. Now, that was if we had non-cumulative preferred stock. Let's do the exact same example, but this time, what if the preferred stock is cumulative? So I'm going to scroll down a little bit and look at a brand new chart. Same data though. And again, we're saying that the preferred stockholders are entitled to 30,000, but we're going to make one little modification. And that little modification is, and it's a huge one, instead of the preferred stock being non-cumulative, now it's cumulative. Okay, what that means is that even though the corporation doesn't have the money to pay preferred, as soon as they do have the money, they will pay preferred back. So in this first year, preferred gets their $20,000, even though they're entitled to 30, right? Common still gets shut out at 0. So from that perspective, we don't see any change from the first scenario to this one. However, because this is cumulative preferred stock, the company is going to keep track of what they owe the preferred stockholders, and what's going to happen is now there's going to be $10,000 that is owed to preferred, and the corporation refers to this as arrearage. So $10,000 will now be in arrears, which simply is just code for as soon as we get the money, preferred stockholders will give it to you. So I'm just going to put this in red ink to make it look like it's like a negative almost. All right, we owe them. So preferred gets their 20, common gets shut out, and there's $10,000 in arrears. So now we go to 2016. The first thing we do in 2016 is we pay back the amount that was in arrears the year before. So we're going to give preferred their $10,000 that we owed them. Okay, so we're giving last year's preferred stockholders their 10. Okay, and that leaves us with what, 18 left. So they'll get the 18 this year. Okay, so now how much is in arrears? So think about this for a second. They were supposed to get 30, right? And only 28 was paid off. And at the same time, 10 of it was from the year before. So let's just put this here. Let's go 10,000 from arrears. Okay, so that we've got that settled. And put a $sign there. Okay, so we gave them the 28, but they were entitled to 30. And there's still, the matter of, we still have another 10,000 to go here. So look at it this way. In 2 years, preferred was supposed to get 60,000, 30 from each year. And the company only had 48,000 to give. So how much is still in arrears? If you said 12,000, you are right. And poor common is still getting shut out. So we had 10,000 arrears from the year before. That was taken care of. So now they're entitled to 38, right? Or another 30. But unfortunately, the company only has 18,000 left in 2016. So we give them the 18, so we still owe them 12. And again, common shutout. Okay. Let's put that in blue too. So now we get to 2017. The company has $200,000 to give. So the first thing we do is we give the amount that was in arrears. So 12,000 from arrears. And we're going to give them the 30 they're entitled to this year. So now the preferred stockholders are getting the 12 they were owed plus the 30, so that's 42,000. And the common stockholders are going to get what's left, and that's 158. Remember in the previous one, in this same situation, common got 170. And now they're only getting the 158. Let's move these a little bit closer together so we can see them. Okay. So if there's preferred, if the preferred stockholders have cumulative preferred stock, that's kind of like bad news for the common stockholders because preferred's going to get even more than what they were getting. Okay. And finally, in 2018, things are kind of back to normal. Preferred gets their 30 like they're used to, and common will get the difference. 350 minus the 30, and they get 320, and that's the same as we saw in the previous chart. Okay, so I hope this was helpful. So let's just recap what we did today. Let me scroll back to the top of the screen. We started out by talking about 3 different dividend dates: date of declaration, date of record, date of payment. The word date of distribution would be used if we're talking about a stock dividend. The typical journal entries on the date of declaration: debit the cash dividends declared, credit dividends payable. Some will not use the debit cash dividends declared. They instead will debit retained earnings. That's kind of a shortcut. If they don't do the retained earnings, dividends declared has to eventually be closed into retained earnings. So you either put it into retained earnings directly or you do it during the closing entry process. No matter how you slice it, dividends ultimately ends up in retained earnings. Okay? And we talked about how because retained earnings is ultimately impacted and retained earnings gets debited, that makes your stockholders' equity go down. And if you're giving your stockholders cash, your cash goes down, which makes your assets go down. So both sides of the accounting equation or both sides of the balance sheet go down. When you have a stock dividend, basically only the stockholders' equity section is impacted. Assets and liabilities are not impacted at all. So what happens is if you're giving your stockholders more stock, the stock account and the PIK account will go up, but it will be offset by the retained earnings, which goes down. Okay, and remember that the retained earnings will completely offset the two positives, and it's basically a wash. So the grand total of the stockholders' equity is the same before and after the stock dividend, but the amounts kind of switch places. Okay. With a cash dividend, your stockholders' equity section literally goes down in value, and so does the other side of the balance sheet. We talked about a stock split, and the stock split, we discovered that after a stock split, the total value of the stockholders' equity, no change, but the components that we multiply get changed. But notice we had 1,002, now we have 2,001. Basically, the result is the same. And then we talked about two different types of stocks, common stock and preferred stock. Talked about how the majority of corporations out there don't have preferred stocks. Basically, like a 3 out of 4 don't have it, so maybe 25% do. And if there is preferred stock, there's different types. Two of them we talked about here, non-cumulative and cumulative. If a corporation has cumulative preferred stockholders, that's going to have more of a negative effect on the common. If the company has non-cumulative preferred stockholders, remember that if the company doesn't have the money in that particular year, that amount that the preferred stockholders were entitled to isn't reached, they just lose out on it. But if they are cumulative, then the amount that isn't reached is remembered, and when the company finally has the money, they will make good on their guaranteed promise. Okay, that's it. I hope you enjoyed this information. The next video is going to be strictly on stock dividends. We're going to analyze small and large and the journal entries associated with it. Okay, take it easy. Hope you have a great day. Again, this is Dr. Lanzafame. We'll talk to you later. Bye-bye.